What is your Standard & Poor's estimate a year out, Jill?
So we're at 3,800 on the S&P 500 for year end. So we are expecting that the market will end the year lower rather than higher. And I think, a lot of the good news has really been priced into the market this year. I think it's been about earnings coming through, which we've seen this earnings season, another really big beat so far. But multiples are very elevated on the index. The sentiment indicators that we track have been growing increasingly bullish, and our Wall Street equity sentiment measure is very close to a sell signal. And I think earnings season suggests that a lot of the good news has been priced in. Companies that beat just aren't outperforming very much, which we saw last quarter. And outside of the last few quarters, the last time you saw that happen was around March of 2000.
Jill, you, Savita, and the team looking for a down market then. Walk me through the sector preference within that call.
So, we still like some of the cyclical areas over defensive. So we're overweight energy, we're overweight financials. I think where interest rates are right now, we would expect them to move higher rather than lower. And we still like value over growth. I think from especially with the jobs report this morning, I think wages are going to be a very important metric to continue to watch. So we're underweight some of the more labor intensive areas like consumer discretionary, where, so far for the S&P 500 margins have generally held up. But this earnings season, you are seeing a big surge in companies mention, labor and wage pressures, where that had been one of the more benign sources of inflation prior to this. So I think a lot of the areas of the market that have a high ratio of employees relative to their sales are going to be some of the areas that, could be more challenged as we move forward if wage inflation continues to accelerate.
Jill, you and the team have done some tremendous work on that, and I've enjoyed reading the research. So thank you. Thanks for providing it. The call for value over growth. I want to understand from your perspective whether there is a bond market call that underpins that view. What is the bond market call, if there is one, that underpins that view?
Well, look, I think there's a number of things, and really what we found is that the profit cycle has been a bigger driver of value versus growth than interest rates. So, really you want to own value when growth is becoming more abundant within the market. Profits growth on a trailing basis is still accelerating. And, the value stocks within the market are actually slated to see better earnings growth over the next 2 years than growth stocks. So, you don't need to pay up for expensive growth if growth has become more abundant and actually better within the value segment of the market. And these value stocks are still generally cheap and under-owned relative to growth stocks. So, I think there's a number of drivers that can even be more important than interest rates in terms of owning value over growth right now.
Jill, you haven't mentioned the Delta variant at all, even though that seems to be mentioned in every other article about the market trend so far. That has seemed to put a crimp in some of the cyclicals and some of the small cap names that I know you track so well. When do you start to care about the Delta variant? I mean, is it impacting your appreciation for some of these stocks, or do you think that this is actually a buying opportunity?
Well, look, I think it's a risk that we're all going to continue to monitor, and there's a lot of uncertainty around it. But I think from a reopening and recovery perspective, there's certainly been pockets of the market where we've seen this grow to become more of a concern. But in terms of other areas, leisure, the overall services spending recovery. I think that's something that we're going to be watching the data very closely on as we move forward. But, overall, as we progress throughout this recovery, smaller stocks are obviously more exposed to the reopening, to the shift from goods to services spending, and they haven't really reflected much of that recovery at all. So they've still been trading at this, double-digit historical discount to large cap peers, even though they're slated to see a better earnings recovery and have more exposure to some of these reopening trends. So, the margins for small caps this earnings season have also still been accelerating despite the pressures from inflation. So, I think there's more room to run on small versus large. They've given up their outperformance year to date on some of these concerns, but I think it's going to be something that warrants continued monitoring going forward and is one of the biggest risks certainly for the market.
We're starting to hear from other Wall Street shops that they are starting to project out to the end of 2022. Have you done that? Does this down market continue through then as people have brought forward so much of the earnings ahead of the cycle?
Right. So we don't have a 2022 target yet, but when we've looked at, what's the best predictor of very long-term S&P returns on a multi-year basis, valuation doesn't tend to be a great predictor over the next, year or so. If you're a longer-term investor thinking about equities over, the next decade, that's where, returns from our long-term valuation framework are going to be much lower than what we've seen by our frameworks than prior years, just given the fact that multiples are so elevated right now. So if you're a long-term equity investor, you're going to see much more tepid annualized returns for equities than we might have seen a number of years ago. So when you add a dividend yield onto that for the S&P 500, we still favor equities over bonds at this point, but certainly that asset allocation decision has grown, less skewed toward equities than it was a number of years ago.